Welcome to the Broken Pie Chart Podcast, episode 275. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, did you enter a bunch of trades at the end of the day, or is this like the market just saying, you know what, Bears? You're not winning.
So we're recording this on Friday, May 31st, the last day of May. And the market had a pretty significant reversal after it kind of bounced off that new low. And the S&P ended up finishing up 80 basis points after being down. I think at one point we're down 100 bips. So it had a nice reversal, a lot of movement in that last half hour. You know, that last half hour, Derek, a lot of people talk about that. And we wouldn't have, I always thought it was silly that people put in these orders that were like market on close. I'm like, why not just buy now? Well, it turns out the whole fund business, everything marks, NAVs and everything mark at the end of the day, and it has to do with create and redeems, and there's all kind of complicated institutional reasons. But today, they were net buyers at the end of the day, and it really pushed the market positive. NASDAQ got back to break even after being down 1.5%. So, but the S&P closed strong, VIX sold off, VVIX under 80. Everything is fine, apparently. That's what we learned in the last half hour today.
Everything is awesome, to quote the great Emmett in the Lego movie, right?
Everything is awesome.
That's
Don't
right.
let me sing it. No.
It wasn't my recommendation today either. I'll save that for later.
Okay.
But to me, though, too, like we went by, there's these sort of regimes that markets get in. And sometimes the market sells off and you buy the dip and it winds up going up. Other times you sell the rip and markets. We're in a situation now where every dip gets sort of bought. I mean, we're still, I think, in a cyclical bull market, right?
Yeah, intraday even, right? Those dips are not even are not followed. We'll see what happens on Monday. But today's reversal was it felt pretty significant to kind of undo this downtrend that had happened for this whole last week of May. Today was an interesting reversal of it. Who knows if that follows through for the rest of the week? But I think it's worth noting because if somebody just looked and said, "Oh, PCE number came out this morning," and market was up 80 basis points, market must have liked it. By the way, the market did like it pre-market, and then we proceeded to sell off throughout the day. But very interesting day. Just kind of shows the churn and indecision that's kind of going on under the surface across the different sectors.
I mean, like Nvidia went from $800 to $1 million per share. No, I'm kidding. It didn't do that. But
is it $1 million yet? I'm not sure.
I don't know. Sometimes when things go up that fast, they got to come down a little bit. Take a breather. We don't know where it's going. That's why we buy and we hedge. But all right, I had this chart when we were down, and I said, I wonder if the Dow is telling us something. It's a chart from Bloomberg, and Dow diverges from the S&P and NASDAQ. And what you saw is starting around, May 20th, I'm going to guess, the Dow started to go down before the S&P and the NASDAQ went down. And we know the Dow has its issues because it's only 30 companies. It's price weighted, not market cap weighted. So it's a little bit different. I don't know. I just thought this was interesting. The old days, you'd say, well, the transports lead everything. The Dow transports. This is just the full Dow. Maybe this would mean more if we were still down 1% today. But I just thought it was interesting. Like one of these has to catch up with the other.
I mean, does it have to? I mean, I know it typically does over time, and eventually it will. But I don't know. I think there's a lot wrong, or different, I should say, with the Dow than, say, the NASDAQ or the S&P. And 30 stocks, you get one or two, little blips, and all of a sudden the Dow is performing very differently. I mean, look, we still talk about it. Everybody talks about it. It's not something we really gauge very much except for the theater of this kind of conversation. So I wouldn't necessarily believe, Derek, that it's a leading indicator, although the way that when we look at this chart that Bloomberg had put on TV, I think this is one of those charts, it did. It led the way down in March before everything else, and it led the way down, in May, but I'm not buying into it that much.
Well, here's the other thing. I mean, Salesforce was put in the Dow, I believe. Didn't they take out Exxon?
Yeah, Salesforce is in, and 2 days ago they got hammered after earnings. Although today they were up 7.5%.
Well, that's why I brought it up. I'm leading the witness here.
Gotcha. Yes, of course, it's one of the 30. Salesforce is in there, right?
And the other thing too is, so United, remember, it's price weighted. United Healthcare was down, and United Healthcare is a it was above 500. Now it's below 500, and so that's a high weighting. That's a definite high weighting. So. Yeah, it acts a little bit differently. Well, here's the other thing. We'll get into some. We're not going to talk election per se, but we will talk about some election-ish stuff we're seeing in the options market. But one thing I wanted to mention is Urian Timmer from Fidelity has a chart, and this is looking at the presidential cycle. We're in year 4 of the presidential cycle, and then next year is year 1 because we'll have a new president or the same president or a different president or whoever it is. So generally this year, the year 4 is the best year. And when you have a midterm year that was down like we did, I think I had read year 4 has never been down since 1900, but I could be making that up. So I don't know. This says the market should be good this year.
From a presidential, and look, obviously that's a hot topic in the news right now with everything that.
Oh, you think
happened?
I wasn't aware of anything going on.
Listen, I don't have any specific commentary on that, except for it was kind of a big nothing in the market today, right? Market didn't really care about the Trump. What are we going to say? The Trump results, the Trump, I don't even know what you want to call that. Now, look, I'm going to go down that path. I'm not doing it. But
markets don't care long term.
They don't care. It's noise in the markets, right? It's not earnings. It's not interest rates. It's noise. Agreed. Yes, I couldn't make that point even.
The Russian ruble is higher than it was when Russia and Ukraine started. I mean, think about that.
Yeah.
Like markets generally don't care over time. They care in the short run, maybe.
Well,
you know what else I care about? And I'm going to, any chance I can to get shipping container rates into the program.
Well, let me talk about the presidential cycle before we go there.
Fine. Go there.
I'm just going to close it out. We've always, in the past, when you look at all of the years in a presidential cycle, typically the third year is the highest. But what you're saying is, when you have a midterm election year like 2022 that was down, you're saying the best year of the cycle ends up being year 4. That's what you're saying. And that is consistent with a lot of the things we've talked about in the past, Eric, about bouncing off the lows after a bear market, what the market looks like 3 months, 6 months, 1 year, 3 years afterwards. It is consistent that you have this kind of run up historically after that. Once you've put the bottom in, and we never know what the bottom is. I think it's fair to say at this point, Derek, we now know what the bottom was in 2022, right? It happened around October, right?
Yeah. If we had a new low now, it would just be
it's a new cycle, right?
It's a new cycle, yeah. Or a pause in the overall bull market cycle.
Got it. So the way this sets up is that and it's funny how this comes out while you're in the middle of the presidential year. But so the way this sets up is this year ends up being of the 4. Doesn't mean it's guaranteed up, although it's interesting that you said it hasn't had a negative year in year 4. It sets up for positive returns on the average of a presidential cycle. Got it. So we have the tailwind of the presidential cycle helping potentially helping the market go higher. And by the way, when you look at that trend, we're right on target with the trend of that last year, right? Goes up pretty strongly in the first half of the year, a little sideways, and then the last 2 months it kind of pops a little higher, finishing stronger. That's what the average trend looks like in this kind of situation.
And in 2026, when we're doing episode, what will that be, like 475 or something? We'll remind people that midterm is actually historically the worst of the 4 years. Midterm years.
Midterm years historically the worst. Okay, there you go. Got it. Not yet, though.
Not yet. But we gotta move stuff around the world, and that's shipping containers. Jay, I know you follow these. Shanghai to Rotterdam in the Netherlands, Shanghai to Los Angeles, Shanghai to New York, and the composite index are all rising. It's costing more to ship stuff, and
Like, what pushed this up this month? What's the deal here? Like, it's like all of a sudden it's kind of trending lower from January down into May. What's happened? Like, what caused this to pop higher?
I mean, most recently, it could be supply. It could be that they're still having to go around they can't go through the Red Sea, so they got to go around.
No, but that was there in April. That was there in March, right? So
maybe the economy's too good. They're shipping too much stuff. People are buying too much stuff on Amazon. I don't know.
I feel like you're giving us the.
I don't know. I'm just looking at the chart. I'll be honest. I haven't done the. I mean, this is the highest that these indexes have been, for the last few years. I mean, going back to pandemic stuff, right? So this is, it's probably worth noting. Why do we care? Because it impacts inflation. Why do we care about inflation? Because inflation impacts interest rates. We're just connecting those and margins and corporate margins.
Sure, and that's true. That's true.
Yeah.
Okay.
All right. But people are still buying back their own stocks. So the S&P 500 announced buybacks is the highest in nearly 2 years. So why does this matter? Because there's a couple ways you can return cash to shareholders. We like to call it, the shareholder yield. You can pay a dividend. You can retire debt. That would be additive to the value of a share. Or you can buy back your own shares. So if you buy back half the float, in theory, I'm not saying this is what they're going to do, but if you bought back half the float and your earnings per share were $10, well, now your earnings per share are $20, right? It's just same earnings, but half the shares.
Half the shares, so you pushes your price higher. So this is a little bit of a hot spot, right, when it comes to taxation and things like that, right? That there's been a focus on, hey, companies that are buying back their own stock. There's probably, there's I don't remember who was probably Elizabeth Warren saying that companies are avoiding paying taxes by doing this. Anything that we should touch on here that this is interesting, that this is on the rise while, people perceive valuations to be going up?
Well, I think Warren Buffett's even said that companies are never great at the timing of when they do buybacks. And the reason is when they're flushed with free cash flow, and is typically when they're doing well and when the market's up. You didn't see massive buybacks at the lows in March of 2009 because a lot of companies were tightening their belts, preserving the cash, or they didn't have as much free cash flow. So, it's good for investors. Warren Buffett, I think, has argued that the prices that they pay matter, and he thinks they pay too much sometimes. But in general, you're returning cash to shareholders. You call this the buyback yield. So it's a positive, and I guess it's a positive too, because they're going into the capital markets and they're having to buy shares. So that helps with flows and that helps with other stuff. I don't know, anything to add on that?
Would it push dividends higher too? Maybe better cash flow. Maybe not. No, less shares.
Yeah, sure.
Yeah, all right.
Yeah, the dividend per share.
Look, it's great. We want companies buying back their own stock, right? That's obviously, it's better than them issuing new stock, which typically pushes down share price. So
I'll do a seminar for the members of Congress to explain return of capital to shareholders and the ways, what a dividend. Here's what a dividend is. I'll get a blackboard. Here's what retiring debt means. And here's what buying back your own shares mean. Or you could spend it on stuff that the return on investment isn't great. That's the other thing. Like if you're a company, if you're a corporation, and you thought you could get a better return from redeploying that capital elsewhere, building a new factory, doing whatever, as opposed to buybacks, they'd probably do that. And so I don't know.
And they probably measure it against the risk-free rate as well, right?
Of
so
course.
It's like, hey, I could get 5% on my cash, or I could buy back my stock.
The other thing this is interesting too is everyone's worried about the fiscal cliff. Not the fiscal cliff, the debt maturity wall.
That's so fiscal cliff is so what, 2013, 2014?
Well, fiscal cliff was that's government stuff. That's
I remember.
All right, but here's my point here. If they have free cash flow, rather than redo the debt at higher rates, maybe they could just retire debt because it will be a better return on their cash than buying back shares. I'm just saying. I haven't done any analysis on it, but they have options. All right, Jay, enough on that.
Okay.
Estimated number of Fed cuts. I feel like we're a broken record. I'm not going to spend too much time on this, but this is a great chart. It is showing in January the expected number of cuts through the end of 2024. That's this year that we're in right now. Was almost 7. And by 7 cuts, 725 basis.
I'm telling you, Derek, we missed an opportunity on that trade. Like, you and I were never even close to the 5 or 6 or 7 camp. I don't know why we didn't take the other side of that trade in January.
Yeah, you trade the Fed funds future with you do the January contract.
Well, we missed it. What happened?
Could have done options on it.
We didn't do it.
I don't know. I'll never make that mistake again. So... All right, so now it's only down to a little bit over 125 basis point cut by the end of 2024. You and I don't want to get into it again. And can I just tell you, the Fed is very, very bad at their own projections. If you go back, and I wrote an article on this on our site, I don't think it's still up there because it's so long ago, where I took the dot plots and I said, what did the Fed say the dots were going to be and what happened in reality? And they were never right. Like, they're really bad at doing long-term projections. In fact, former Fed Governor James Bullard once did not submit a dot because he said, we're just bad at this. This to me, though, it's like, what did you think was going to happen if the economy was good? All right, I'm done. I'm not going to get up on the soapbox.
No, listen, I don't have too much to add except, yeah, I'm with you. By the way, I'm looking at the probabilities of the Fed cuts. So the first Fed cut looks like it's September with the greatest probability, but ever so slightly, 46.6% chance that first cut happens in September at the September meeting. By the way, there's a 46.2 chance, so just 40 bips less, that it stays the same. So, I'm going to say September right now is 50-50, and then it moves to November as 46 compared to 33. So, yeah, September's kind of tracking here. We've talked a lot about that. Interestingly enough, there's a Fed meeting on November 7th. When is the actual election? I don't know why, November 6th is in my head. Maybe that's the wrong year.
It's November 5th or 6th. I think it's the 5th.
November 5th.
Yeah.
So 2 days later. So anyway, not that really matters, but still looks like, first chance in September. And you're right, only one seems to be where the probabilities lie for the rest of this year. Great. I think that makes sense. It could be 0. I think you and I are starting to lean. Maybe it's even 0. Like, we were 1 in the beginning of the year. Now we're leaning towards 0. I think.
I'm not at a hike, but there was a Bloomberg article, and I didn't prep it for our show today, I think it was former Fed Governor Bill Dudley made the argument the Fed is not restrictive enough based upon where interest
that caused a problem in the markets a few days ago.
Yeah.
Yep.
They didn't like that.
No.
Here's the thing, though, and if you've read the book, A History of Interest Rates by Homer and Shiller. It's like 700 pages about the history of interest rates, going back to the Roman Empire. And I know I'll buy that for you for Christmas, Jay.
Did you say the Roman Empire?
Yeah, well, it goes back to 3000 BC. When was
we've
the Roman
got
Empire?
Good data. We can't get good data from 3 weeks ago. We've got 3000 BC. That's funny. That's great.
You should read the book, and then you can decide.
I've already decided it's not accurate just by the fact they have Roman interest rates.
Okay. Well, here's the point. We're looking at a chart, and it's taken from the book in the Bank of England. When I wrote my book, I actually pulled, I think, rates going back to the year 500 from the Bank of England. They were nice enough to have that on their site. Here's the point. Long-term rates and short-term rates, they were off a 5,000-year low, according to this chart. Okay. And right now, if you look at where short rates are, they're back where they were right around 2000. And, they were higher. We know that late 60s, early 70s, early 80s, through the 80s and 90s. And, they're also right in from 1825 to 1900 or so, right in that mix again. Why am I talking about this? Rates aren't that high. It's we need to get over it. I'm sorry.
You're saying in the last 5,000 years, we're kind of at the average?
Yeah, looks that way, right?
Okay, 5,000 year average.
Mm-hmm.
Can we get a price of gold in here for 5,000 years? I would believe that more than interest rates.
I'll make a note of this.
All
but
right.
This leads into the next thing, and I've heard a lot of talk from younger investors, just younger people, and they are basically of the opinion that home ownership or the dream of home ownership is dead. There's no way their generation will ever be able to own a home. So what did I do? I went back and I looked at some data. I went back to 1971 and I did the median home price. So that's, you don't have Bill Gates's mansion. You don't have, the very lowest home prices. It's the median. It's like the 50th percentile, right? That's a good way of looking at it. So so I looked at that and I said, let me inflation adjust it. So you can't, this is the problem. Sometimes people look at, home prices were only $40,000 in 1970. Yeah, that's in 1970 dollars. So you have to inflation adjust that to today's dollars. And then I also I said, what if you had to take a mortgage? You didn't put any money down, but you had to take a mortgage out and you had to make a payment based upon the average 30-year mortgage rate on the median inflation adjusted home price. Make sense?
Makes sense to me. So you've kind of level set the playing field to say how expensive are mortgages today compared to the last 50 years.
Yeah, it's like what is your payment? Okay. At the end of 2023, the $2,705 would be the monthly mortgage payment based upon what the rate is on the median sales price home in the U.S. And then I charted that.
How much of a mortgage you got in this scenario? 80%?
I just did it on 100. I said, let's say you
like
did
100.
0 down.
Okay, so the whole value of the house. Got it.
Yep,
okay, so which means it'll probably in reality be less. But okay, go ahead.
Yeah, and by the way, $457,308 is the median inflation adjusted home sales price in 2023. Okay, so call it $460,000, $2,700. But here's the thing: home prices have been going higher, but for a long time, the average mortgage payment has been going down because obviously interest rates have been going down. All of this to say the average mortgage payment is higher this year and last year and the year before than it has been since, I'd say 1985, 1987.
Okay, so let's talk about this. So $2,700 a month works out to be about $32,000 a year. And what's the general guideline, right, that we're all kind of taught on how much you should be spending on your on shelter, right? It's about 30%. Now, there's probably other things like insurance that you don't have it in there. There's, taxes and all that other kind of stuff. But if you're just to look at that, let's just say that's probably another, I'm going to guess here, another 20% on top of that, right? Between your insurance and taxes and whatever else goes into it. So now you're talking about 32,000 times 1.2, you're at $38,000. If you had a third of your income allocated towards shelter, it means if you're making $115,000, you should be able to afford a home. This average home, right? Mm-hmm. So that's kind of the salary range. So if you're making $115,000, today's math says you should be able to afford a home. You're not overextending yourself. I don't know about you. My first home, I absolutely overextended myself because you wanted to buy a home, right? But I grew into it. But I don't know, Derek. It doesn't seem like it's that outrageous. Maybe not right out of school to make $120,000, but you're working for a few years. You're ready to stop renting. You saved a few bucks. I don't think that's ridiculous, and that's at 100% mortgage, right? So you're probably only paying an 80% of the value by the time you do that. So,
right.
So times 0.8. So now you're at like $100,000. You should be able to afford a home. I don't know what percentage of Americans make $100,000 a year. Do we know? Can you find that quickly on Bloomberg? What percentage of Americans have $100,000 a year of income?
That's got to, I guess that's the 80th percentile at least.
You think?
I think so.
80th? Okay.
I think so.
We could ask the Google machine.
We could. Well, here's the issue. You could look at personal income. You could look at household income. Personal income includes government transfer payments. They include everything. So yeah, I mean, if we just say what's the median income in the U.S.? Let's see.
I think you're gonna be surprised at how low that is.
I don't think I will. You tell me.
18% of U.S. individuals make more than 100,000.
Yep. Now that's the average. That's the average. Median home price, right?
Yep. Because it depends where you live.
Yeah, and you don't have to buy the average house.
Yeah.
That's the 50th. The breakdown. So I don't know. I mean, this is. Basically, though,
it's not a never. Hey, Gen Zers, it's not a never, right? It's doable.
No, because all you need to do, I mean, if you go back to, look, I mean, I don't think, I just said we were at a 5,000-year low in interest rates, according to that book. And that I
think you should not say that again. Just my advice.
2016, that same mortgage was $1,962. Okay. I mean, I think there's also an interesting opportunity because so many people have mortgages that are still much lower. And if they are renting out those properties, what do they call it? The cap rate? Like they don't need as much they don't need to charge as much rent to capture their payment. So maybe there's like this mismatch where instead of buying a place, you're renting a place from somebody who has a really good mortgage.
Well, I think we know right now it's cheaper. It actually is one of the first times where it's cheap. It makes more sense to rent versus buy. We've talked about that before, right?
Yeah.
So,
yeah. All right,
there you go. It's not a never, but maybe it's a little harder, but it's not so hard. Gotcha.
I mean, sure. I don't know what else. I'll do some more work on this. I think multiple things can be true at the same time. And the idea that, it's the worst ever. No.
It's not the worst ever. No, clearly it's not the worst ever.
No. 70s, early 80s was not great. And yes, home prices were much lower, but if you took out a mortgage, you might do an 18% mortgage. Nothing fun about 18% mortgage. So, all right. We do need to get into politics. I'm sorry. We got to do it, Jay.
Okay.
And the reason why I got to do it is because we've talked about the little election blip. All right, so let me just set the stage here. The VIX is what you see on TV. It is the 30-day measure of volatility on the S&P 500. But when you trade options, you're trading it on the future. And the futures contracts, you might have one that expires this month, that expires next month, the month after that, all the way January of next year, February next year, and beyond. And the interesting thing is, what did the VIX close to? Well, when I took this, the VIX was under 14.5, the spot VIX, what you see on TV. But there's this huge kink. There's two kinks, though, now that I've noticed. October, the VIX future is over 18. And I think it's the January, February of next year, it is over 18 as well. And it's very striking on the chart. So to me, this is saying, I mean, are people like really bidding up the future and buying options on the future because they think there's going to be volatility around the election and volatility around kind of when one president would leave, one would come in, or one would, they have to get whatever they got to do to transition or not transition. Seems like that's what's going on. It's pretty clear to me. Like, why else would people
I don't disagree with the October pop. Be weird because guess what? The actual election is in November. We've already established that. But fine, leading up to the election typically has volatility. I get it. It's happened almost every election year. By the way, September, typically the worst month of the year. It's the only month that has a negative average in the last 75 years. October has some of the biggest swings. Some of the worst market days have happened in October. So I think there's generally, if there's going to be volatility, it happens September, October, maybe a little more around the election. Fine, I'll give you that one, Derek. I'm not in the camp that this push higher has to do with the transition of government. I don't think that's the problem at all. I think it's just the natural, time to rehedge and lock your gains in for the new year, and then have the decision if you want to let that hedge, realize the gains or losses around the calendar year. I don't think it has to do. I would disagree that it's a transition of power like the January 6th thing that's driving that number up. I just think it's the normal flow of what happens as you're looking to roll out and add protection. By the way, I don't think it's a bad idea to lock in gains while the market's at highs and hedging is cheap, right? We've talked about this before. The cost for adding, long puts or long put spreads to a portfolio right now to kind of put a floor in your portfolio is at some of the lowest levels we've seen in the 14, 15 years we've been doing just ZEGA strategies, right? Let alone, our other history, Derek, of 25, 30 years of trading options. So,
right.
So I don't think it's a bad idea. I definitely don't know if it's indicative of something crazy happening in the markets in January.
All right. I'll take the other side. I think maybe there's some volatility tourists who are like, oh, I think there's going to be volatility, so I'm going to buy a bunch of really far out of the money, cheap VIX options. Jay, just to kind of give you the lay of land here, I looked at July, and what I pulled up is the open interest, and I have this chart that looks at all the different strikes. To give you the context, the max open interest in the July contracts for VIX options on the VIX future is 13. A little bit 14, 16, 20, 22, not much after that. You go to the election, it's just striking the difference. You've got open interest, a lot of open interest, anywhere from 14 up to 21, 25, there's a spike. The max call open interest is 42.5 for the October contract. And there's other ones too. There's open interest. Then you go out to, this is the January 22nd VIX expiration. 80, 85, 90 strike, a lot of 40 strike, a lot of 30 strike, a lot of 20 strike. That's the max open interest. Who's doing that?
All right. First off, not very many people. So let's put this into context, Derek. So now I'm going to come back again.
Okay.
What's the size of this open interest, right? It's not even 1,000 contracts, right, at those levels.
So it's not institutional then. It's retail.
This is not, I don't think it's, now granted, the October pop in those 42 halves is certainly interesting. I will grant you that. When I look at the VIX options themselves, there's 100,000. So I think this is an offset here. So actually, this is the options on the VIX, Derek, that I'm looking at. So you're right. There's 100,000 contracts of open interest on the October 42.5s. That is a lot. That is by far the most of that series. Putting it into context, right? So for this month, let's take a look at what's happening, what the current month looks like, or maybe let's find where's the end, the Junes. There are multiple strikes with over 100,000 contracts. There are some strikes with 200,000 contracts. So and this is normal, right? The VIX volume is always kind of front loaded to the current month. We know this, but you're absolutely right in saying there's something at that 42.5 where there's 100,000 contracts in the October expiration. But you go out to the Januaries, right? And I would say it's not a lot, right? It actually, it looks like it's actually a spread of 500 contracts on the 85 by 90. It's about 500 on each. Someone threw in a little spread here, a $5 spread. Probably cost them 4 cents to put that 5 cents to put that trade on. Max gain there is $5. It's a flyer for a small cost, right? I would say I wouldn't get too worked up about that. And by the way, this is what happens. You get a few contracts way out there on the curve. It does skew the way that the averages are calculated. But I'm going to say I'm going to ignore it. I'm going to say it's a little noise. It's noise. It's there. You heard it. I think it's noise.
I think this is misinformed positioning, and it's all right. Let's just think about that. Let's use the $40 strike for Jan 22 of 25. So what are those, like 40 cents?
The
calls.
A little more. The Jan 25 40s looked like they went out at 70 cents today.
Okay, so 70 cents for a 40 strike. So let's just think about what that means. Let's say you're like, oh yeah, I think there's going to be volatility between now and the January. I can't remember what that is. The what do they call that? The ceremony when the president goes.
Inauguration?
Yeah, there you go. The inauguration.
Okay.
Yeah, that little thing. All right. So let's say somebody's like, yeah, I really think VIX is going to spike between now and then. Great. Let me spend 70 cents or 75 cents on a 40 strike VIX call. Let me just explain this. Let's say the VIX tomorrow, well, Mark's the number tomorrow, Monday goes to 70, the spot VIX, or it goes to 40, whatever it is. That is not moving. That contract is still going to be, what does it go? 18 to 22, 18 to 23?
Maybe.
Monday.
Yeah.
Maybe. Like, I mean, this is why it's so difficult, because if you're doing this bet, you're saying, I'm going to buy the 40 because I think that in the month leading up to expiration, I think the VIX is going to be much higher than 18, and it's cheaper for it to buy now, and then it's going to spike up a lot. And your break even is basically $40.70. So yeah, if the VIX closes at 40.7, you break even. Congratulations. Like this.
Look, I would say if with 2 weeks to go, that looked like it might get to 40, you might get a bid in that option. Meaning, let's say it rose from 20 to 30 with 2 weeks to go, in the first 2 weeks of January, maybe you'll get out of that thing for $1. Maybe, right? Because that's the thing. The thing with the VIX call is you absolutely have to get the price and the time right. And the time is even more important than the price, right? It's all about getting the timing right. So if you have a spike in October, this January option is not going to show very much movement, right? That's your point. It has to happen right before it. And it would have to be trending up. Like if we went from 13 to 20, 20 to 25, 25 to 30, and then you get a pop to maybe 33, you're like, maybe those 40s are going to be worth something. But other than that, this thing is going to tick off, right? Tick off, theta decay, contango decay, all those things we've talked about in the past. It's going to work against you. It's a dangerous trade. By the way, when I look at, so dangerous from a, low probability of success is what I would say. By the way, 2,000 contracts in total open on those 40s, right? So 2,200, by the way, no volume today, 2,200 contracts at 70 cents, it's a $140,000 trade. If you decided I'm going to buy all this, if one person put money against this, one institution did that, they spent $140,000. It's not a ton of money for a fund to throw that trade in there, right? It's not a big deal. By the way, the other weird payoff, those 85s by 90s that only cost you a nickel, that's a $2,000 trade, right? 500 times. It's not a lot of money getting thrown at this. But where that big number was those the 100,000 contracts for the October 42 and a halves. That's a significant position. That is the one that's 40 cents, Derek. By the way, think about that. October, it's 40 cents. That same trade, go out to January, it's 70 cents. there's a pretty, that extra few months cost you 30 cents to add it on there.
Well, it's cost to carry in there, right? I mean,
of course.
It's in there. Yeah, sure. But, also, all right. I mean, it's just, I look at this stuff and I think, what are people doing here? Like,
what are they doing? I think that's it. And I think it's a little noise. I don't think it's an institutional bet. I don't think it's a position. I think it's just someone saying, hey, if there's going to be a little volatility, maybe these are the months that are going to do it.
It's not really what I would recommend, though. If somebody wants to hedge a portfolio, I'd much rather see them do what we do. And if people want to know more about that,
absolutely. No, this is a hard way to hedge. This is a very difficult way to hedge, right? So buyer beware if you're trading VIX options. Much easier because you actually get intrinsic value when you buy puts and the market drops and goes through your strike. That put actually has some real value to your portfolio. A VIX option could have negative intrinsic. We've seen it happen multiple times, right? Because the market doesn't believe where the VIX is marking is where it's going to end. So that is a difference, right? It's like just buy a put if you want some protection. By the way, it is one of the most affordable periods to just buy a put if you want to lock in some of your gains.
Yeah.
Or you want to be able to rebuild a position from here. Like it's a good time to add hedges if that's what you're trying to achieve.
Derek.Moore@ZEGAFinancial.com. That's DEREK.MOORE at C as in zebra, E as in Eddie, G as in George, A as in Apple. Financial, you got to get that correct on your own. I did get a question too, and I'd be curious from the listeners. You can shoot me an email. Somebody asked if I would consider doing a newsletter where I just post these charts and we send it out to people. I don't know. Let me know if that's something you're interested in.
We've talked about a chart package, Derek. Chart package would be nice. Yeah. You do put a lot of time into this. I think you should.
I do. All right. One other thing. Well, I got another couple things here, but I guess just one more thing in this VIX. I think the point I'm trying to make is think about what it is you're trying to do. And if your goal is to hedge, this may not be what you want to do because the confluence of things that have to go right for some of these deep out of the money VIX options to work for you and do what you want, you may not be getting what you want and what you need. All right. Shiller PE ratio, Jay.
Oh, gosh. We're going to talk Shiller? Okay.
Well,
didn't he win an award for something? Wasn't he recognized for his innovation in analysis of financial conditions?
I don't know. I'm sure he probably
something.
All right. So Shiller PE is 34.5. If you look at a chart at it. So the Shiller PE basically... It's sort of you look at cyclically adjusted PE ratio. So I think you average the last 10 years and then you divide it by the price. So it's high, but if you sold your stuff every time this got above the average, you'd miss a lot of markets. But Urian's getting 2 mentions today from Fidelity. He's got a chart that basically shows starting valuation affects future returns. And what he did was he plotted the cyclically adjusted PE, which is kind of the Shiller PE, and said, if the Shiller PE is here, your annualized compounded growth rate over the next 10 years is only this. And if my eyes are correct, it looks like, based upon where the Shiller PE is, the next 10 years, you should only get a little bit over 2% annual return. Basically, the lower the Shiller PE or the cyclically adjusted PE, the higher the future 10-year return. I don't know.
So look, Shiller would say the market's overvalued. You're not going to get a lot of growth based off of. By the way, I think the Shiller PE ratio evaluates over a 10-year period on its own, right? So it looks at the past 10 and then say this chart is telling you what the future 10 is going to give you. I think we beat this thing up in the past, right? I don't want to spend too much time on it. There's a lot of folks that believe in that methodology. I'd love to know what this looked like 10 years ago, right? So in your chart, Derek, right, you have where the Shiller PE was in let's just say 2015, right? Looked like it was about a 25, right? Shiller PE ratio.
25, 26, sure.
25, 26. When I look at this chart at the 25, 26, it says what? We should have a compound annual growth rate of like 6%, right?
Yeah, 6, 7, something.
Well,
there.
we know it's been significantly higher, right? The market has returned more than that. So I don't know. I don't really subscribe to this methodology for projecting future compound annual growth rates.
All right. I'll cross off Robert Shiller's book as a potential Christmas gift, but I'm keeping the history of interest rates over the last 5,000 years on the list. Any recommendations, Jay, this week?
Okay. So I told you last week I was going to watch Dark Matter on Apple, right? I think I'm all caught up. I do think you kind of overplayed it a little bit. Like, it's fine. It's good. I can't for the life of me figure out why it's called Dark Matter. I'm like 6 episodes in and not once has dark matter been mentioned. I feel like he's just, the author was just picking a popular science theme and them going up. I get it that there's the concept here of quantum mechanics and superposition and all of it. Dark matter is not mentioned once. Dark, does it eventually show up?
I remember it in the book.
All right. Well, you've seen the show. Have they mentioned dark matter once?
I stopped watching it because
You've been disappointed. I gotcha.
Well, it's hard to watch something when you've already read the book because I know what's coming.
You've been disappointed.
And it rushes it. Like, there was a lot of talk about the process of how this person is going between places and things like that. So maybe if you read the book, it'd be different. I don't know.
All right. And I know you're a big fan of the book, and I can see that the concept is interesting. I've been meh on the show.
Right.
I'll give you another show I've been watching that is kind of light and not a hard thing, not, have to make a big commitment to it. But like, if you feel like being on your phone and having a show kind of going on in the background, sometimes that happens sitting on the couch. On Hulu is a show called Will Trent. It's kind of a little bit of a Georgia kind of police story. Nothing to do really with Georgia, but just it's kind of like, it's like a detective show, right? And a little interesting. So we find it entertaining. So Will Trent on Hulu. If you haven't watched it, not bad.
Okay. Will Trent.
You're not going to be blown away with it. It's no Succession or Game of Thrones, but it's fine. Low commitment, easy to watch. Keep it on in the background.
All right. Mine this week. Last week I had a sell recommendation. I don't watch. This week I've got a buy recommendation on HBO. Movie Pass, Movie Crash. It's a documentary. I thought it was awesome. And I didn't realize this, but the 2 guys who sort of ran the company into the ground were not the original founders.
Really?
Yeah, they sort of muscled them out. So, I think everyone knows what Movie Pass is, but the idea you pay a flat fee and then you can go any movie, any day, as many as you want. And then, so if people go to 5 movies in a month and they charge $10, you're going to lose money on that. So it was really interesting. And I guess the 2 guys who came in, they've been brought up on securities charges. I don't think they've gone to trial yet. But the original CEO, interesting guy, Stacy Spikes. Is that I'm trying to remember his name. But it seems like, and he actually has rebought the rights to it. So now he's relaunched it. So he's got it back. But pretty interesting. I think you'd like it. And they spent a lot of money, those guys.
Really? Okay. Well, that sounds good. Is there anything that you're kind of looking forward to seeing?
No.
You're a Star Wars guy a little bit, right?
Oh, is there something new coming out?
Yeah, The Acolyte on June 4th. So by the time people hear this, it will already be out. I'm absolutely looking forward to it.
Okay.
Yep.
Is that a movie?
TV show on Disney Plus.
Okay.
June 4th, The Acolyte.
I realized they were putting out too many movies, but I think the movies are better than the shows.
There's plenty of talk of another 3 coming out, like more focus on, if you follow the movies, right? More focus on Rey. And then I saw that there's going to be a Darth Vader trilogy, which absolutely I'll have to watch that.
All right. That's it, Jay. We're done.
Okay, Derek.
All
Thanks
right,
again.
everyone. We'll see you next week. And that's it. CJ.
Bye.